So imagine buying a brand new car.
Okay.
You drive it off the lot. You take it to work every single day. You'd go on these long road trips across the country. And then after an entire year, you look down at the dashboard.
Right.
And the odometer hasn't moved a single mile. It still reads exactly what it read the day you bought it.
Yeah, you would know instantly that something is fundamentally broken.
Exactly. I mean, intuitively, the numbers on the screen are actively contradicting the reality of what the machine is actually doing.
Mm-hmm.
And, well, today we are looking at a multi-million-dollar corporate financial statement that did exactly that.
Yes, why?
A massive number just sat perfectly still for a year while the company claimed it was, moving. And they filed those statements as perfectly compliant.
Which is the crazy part.
Right. So, welcome to a brand new deep dive right here on the Gap Advisors Ind AS Clinic podcast. Whether you are an auditor prepping for a grueling review cycle, a CFO catching up on the absolute latest in compliance, or you're just someone who loves unraveling complex accounting mysteries, this conversation is tailored specifically for you.
It is fantastic to be here. And before we start looking under the hood of this particular financial statement, we really have to establish the baseline parameters.
Yeah, the ground rules.
Exactly. We need to define the physical laws of the universe we're operating in today, just so the math makes sense later. So throughout this deep dive, the functional currency and the presentation currency we are discussing is the Indian rupee, the INR.
Okay, got it.
And any currency that is not the functional currency is considered a foreign currency. Furthermore, and this is really crucial for the timeline of the stagnant numbers we'll be looking at, the reporting period in focus begins on the 1st of April and ends on the 31st of March.
Perfect. So those are the ground rules. Now let's talk about where we actually sourced this puzzle, because this is not some hypothetical textbook exercise drawn up in a classroom.
No, not at all.
We are dealing with an observation stemming from the actual published Ind AS financial statements of a listed company. And the way this error was found is actually really fascinating. These statements were downloaded and independently reviewed by Gap advisors on a purely suo moto basis.
Right. And for those who might not be familiar with that legal phrasing, suo moto essentially means, well, on its own motion.
Right.
Gap Advisors wasn't hired by this company to find this error. They weren't tipped off. They were simply reviewing publicly available published data to see how standards are actually being applied in the wild.
Which makes it almost like forensic accounting for sport.
Yeah, basically.
And this specific, incredibly detailed observation was prominently featured in the 226th edition of the Gap Advisors Task Weekly newsletter. And that newsletter is authored by C.A. Manish C. Iyer, who is the director at Gap Advisors. It's published directly on LinkedIn.
And they've put out over 230 editions to date.
Which is a massive archive. Honestly, if you are operating anywhere near this space, you need to subscribe to that newsletter for free on LinkedIn. It's just a constant feed of real-world application issues.
It absolutely is. And because we are diving deep into a specific interpretation of these standards today, we must provide our mandatory disclaimer.
Yes, please.
The views expressed in this deep dive are the personal views of the author of the newsletter, C.A. Manish C. Iyer, and they are not binding on you, the listener. We are analyzing a complex interpretation of financial reporting standards. You are strongly requested to seek the help of a qualified expert before taking any action or refraining from any action based on the views discussed in this audio.
All right, the legal parameters are set, so let's outline the mission. We are going to deconstruct a real-world financial statement disclosure regarding an investment made by a parent company into the preference shares of its subsidiary. Right. We're basically going to pull on one specific thread, just a single classification decision made on day one. And by pulling that thread, we're going to trace a path through Ind AS 1, Ind AS 27, 32, 107, 109, and even Schedule 3 of the Companies Act, 2013.
It's a long path.
It is. We are going to see how one seemingly minor, maybe even well-intentioned decision to split an asset creates this massive, undeniable mathematical contradiction. So tell me about the initial observation. What was the red flag that started this whole investigation?
Well, the trigger was actually found deep in the notes to the financial statements. Specifically, the company disclosed its categories of financial instruments in Note 37A of their financials.
Yeah.
They were detailing their investments in 6% cumulative redeemable preference shares of a subsidiary called Eastern Coalfields Limited, alongside a 5% stake in Herat Coke and Coal Ltd.
Let's pause right there, actually, because even the name of the instrument holds clues. 6% cumulative redeemable preference shares. Break down what that actually means in the real world before we get to the actual accounting error.
Gladly. So a preference share sits somewhere between a traditional equity share and a debt instrument, like a bond.
No.
It gives the holder preference in certain areas, usually meaning they get paid their dividends before the common shareholders see a single rupee. And, they have priority if the company ever liquidates.
So safer than common stock.
Exactly. And the 6% means there is a stated dividend rate. They are supposed to get a 6% return on the face value of those shares.
And what about the cumulative part?
That is vital. Cumulative means that if the subsidiary, Eastern Coalfields Limited, has a bad year and cannot afford to pay that 6% dividend, the obligation doesn't just disappear.
Right, they don't just get off the hook.
No, it accumulates. It rolls over to the next year. So next year they owe 12%. It creates a hard accumulating obligation. And finally, redeemable means these shares have a lifespan. The issuer, meaning the subsidiary, is required to buy them back to redeem them at a specific point in the future. They must hand back cash to the parent company.
So if I'm the parent company holding this, I'm expecting a very specific stream of cash flows.
Sure.
I'm expecting my 6% every year, cumulatively guaranteed, and eventually I expect to get my principal amount back when the shares are redeemed. It sounds very much like a loan dressed up in fancy equity clothing.
You are hitting on the exact tension that causes so many accounting failures. But let's look at what the company actually printed in their annual report, because they didn't just list this investment as one line item.
What did they do?
They took this investment in these 6% cumulative redeemable preference shares, and they split it into two distinct parts on their balance sheet.
They divided a single instrument.
Yes. They created an equity component, which they valued at 855.61 crore rupees. And they reported that exact same 855.61 crore figure for both the financial year ending 31st March 2019 and the year ending 31st March 2020.
Wow.
Then they created a separate debt component alongside it, valued at 1794.99 crore rupees in 2020.
Okay, that feels strange, but I don't know. Maybe they have some complex internal model. Where's the actual standard violation there?
The crux of the issue is in the measurement category they applied to those pieces. The company explicitly stated in their notes that both the equity component and the debt component are measured at amortized cost.
Wait, both of them. They labeled an equity component as being measured at amortized cost.
They did.
I have to challenge that immediately. Why would a company even attempt to split an investment they've made into two different pieces like this? What's the motivation? Think about buying a house. If I buy a house for $1 million, I don't put it on my personal balance sheet by classifying the bedrooms as real estate and the kitchen as a liquid asset just because it has running water.
Yeah, exactly.
It is a single asset.
Right.
I bought a house. Why is a company taking a single financial instrument they purchased and trying to divide it into equity and debt buckets?
Well, your house analogy is spot on regarding how an investor should view an asset. But to understand the company's motivation, we really have to look at the pressure they face on the very first day of the transaction. We need to talk about day one fair value differences.
Okay, walk me through that. What happens on day one?
Let's create a hypothetical scenario to map the mechanics. Imagine a parent company decides to inject cash into its subsidiary. The subsidiary needs capital, maybe to build a new factory, right?
Right.
The parent company gives the subsidiary 1,000 crore rupees, and in exchange, the subsidiary gives the parent these 6% cumulative redeemable preference shares.
Okay, 1,000 crore goes down, shares come up.
But here is the catch. The accounting standards, specifically in AS 109, require financial instruments to be initially recognized at their fair value. And fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date.
So it's the open market price.
Exactly. It's the open market price.
So the standard is basically asking, if the parent company wasn't your parent, what would a totally independent bank charge you for this exact same deal?
Precisely. And let's say an independent bank looks at the subsidiary, looks at their credit risk, looks at the market conditions, and says, well, we wouldn't give you 1,000 crore for a 6% return. We would demand a 10% return.
Because 6% is too low for the risk.
Right. Because the parent company is accepting a lower return, 6%, instead of the market rate of 10%, the actual fair value of those shares on day one is not 1,000 crore. If you calculate the present value of those 6% cash flows using the market interest rate of 10%, the fair value might only be, say, 800 crore rupees.
Okay. So the parent paid 1,000, But the asset they received is objectively only worth 800 on the open market, so there's a 200 crore missing piece.
Exactly. The transaction price is 1,000, the fair value is 800. That 200 crore is the day one difference. The accounting standards force the company to explain what that 200 crore represents. Because in a transaction between unrelated parties, a difference like that would usually be recognized immediately as a loss in the profit and loss statement. You made a bad deal, take the hit.
But a parent company isn't going to accept taking a massive P&L hit just for funding its own subsidiary.
Right, exactly. And they shouldn't have to because the economic reality is different here. The parent company argues, look, we didn't just lose 200 crore, we gave our subsidiary a favorable deal because we are the owners. That 200 crore is essentially an extra capital contribution. It is an investment in their equity.
So that is where the motivation to create an equity component comes from. They want to park that day one difference, that missing value, on the balance sheet as equity, rather than letting it drag down their reported profits.
That is the exact motivation. They are trying to reflect the economic reality that they subsidize their own subsidiary. This leads to the concept of compound financial instruments, where a single contract has both a liability component and an equity component. However, the author of the newsletter, C.A. Manish C. Iyer, points out a massive fatal flaw in how this company applied that concept. The author actually calls it the splitting fallacy.
Fallacy implies they're fundamentally misinterpreting the rule. So where did they go wrong?
Well, they conflated the rules for the issuer of an instrument with the rules for the investor holding the asset. And those are two entirely different universes in the accounting standards. Let's look at Ind AS 32, which governs the presentation of financial instruments. Based on the nomenclature of the instrument, cumulative redeemable preference shares, this is not a compound financial instrument from the perspective of the issuer, according to paragraph 28 of Ind AS 32.
Why does the word redeemable kill the compound instrument idea?
Because equity, by its purest definition in the standards, does not have a contractual obligation to deliver cash. If I own shares in a public company, they don't have to ever give me my money back.
Right.
I can sell the shares to someone else on the market, but the company itself has no obligation to redeem them.
Right.
A redeemable preference share, however, has a hard date where the issuer is contractually obligated to hand over cash to buy them back. Therefore, it's fundamentally a liability. It doesn't have the characteristics of equity that would allow the issuer to split it under paragraph 28.
But let me push back on that for a second. The issuer is the subsidiary. The financial statement we are looking at belongs to the parent company, right? They are the investor. Does that change the math?
It changes the math by making the split even more explicitly forbidden.
Really?
Yes. Let's play devil's advocate. Let's pretend the instrument actually did qualify as a compound instrument for the issuer. Even if that were true, the parent company is the investor holding the asset. And Ind AS 109, the standard governing the recognition and measurement of financial instruments, has a very specific, uncompromising rule for investors holding hybrid contracts.
Okay. What is the rule?
It's paragraph 4.3.2 of Ind AS 109. It states, and I will quote the mechanism directly here, if a hybrid contract contains a host that is an asset within the scope of this standard, an entity shall apply the requirements in paragraphs 4.1.1 through 4.1.5 to the entire hybrid contract.
The entire hybrid contract.
Yes, the entire thing. No splitting allowed. Zero. If you hold a financial asset, you must evaluate it as a single holistic unit for classification and measurement. Going back to your house analogy, Ind AS 109 explicitly forbids you from putting the kitchen and the bedrooms in different accounting buckets. You hold one asset. You measure one asset. You cannot arbitrarily divide a financial asset into an equity component and debt component on your balance sheet.
But if the standard is that explicit, I mean, if it literally uses the word entire, how does a listed company with layers of auditors and finance professionals decide to just chop this investment in half anyway? Where do they derive the confidence to do that?
That's a great question. The author of the Task newsletter points toward a very likely historical culprit. It's an issue of applying a highly specific advisory opinion to a broad category of instruments. The assumption is that the company split this asset based on a past opinion given by the Expert Advisory Committee, the EAC, of the Institute of Chartered Accountants of India.
Okay, I need some context on the EAC. What is this committee, and why does an opinion from them carry enough weight to seemingly override a direct reading of Ind AS 109?
Well, the Institute of Chartered Accountants of India, or ICI, is the premier accounting body in the country, and the Expert Advisory Committee is a specialized wing within the ICAI. Companies or auditors can submit highly complex, specific, real-world transactions to the EAC, and the committee will issue an opinion on how the accounting standard should be applied to that exact, narrow set of facts.
So it's almost like asking a Supreme Court for a ruling on a very specific case.
Exactly. Now, the EAC had previously issued an opinion regarding concessional loans given to subsidiaries. A concessional loan is just a regular loan given at a below-market interest rate, like a 0% loan. In that highly specific context, the EAC advocated that the parent company could recognize the day-one difference, that gap between the cash given and the fair value of the loan, as an equity component representing a capital contribution.
Ah. So the company in our deep dive saw that EAC opinion on 0% loans and said, hey, great, we have a day one difference on our preference shares. The EAC says we can call it equity. Let's split the asset.
That is the presumed logic, yes. But the author of our source material strongly disagrees with applying that logic here. The author argues that you cannot just copy-paste an EAC opinion onto a different type of instrument, especially when it directly contradicts the strict definitions within Ind AS 32.
I see. And the author brings up this incredible conceptual debate in the newsletter. The substance of the contract versus the substance of the relationship. Let me see if I can articulate this because it really feels like the philosophical core of the error.
Go for it.
Let's say my brother wants to start a restaurant, and I lend him $50,000 at a 0% interest rate. Now, the contract we sign is unequivocally a loan document. I expect to be paid back my $50,000 in 5 years. The fact that he is my brother, the relationship, explains why I gave him such a sweetheart deal instead of charging him bank rates. But that familial relationship doesn't magically turn my loan document into an ownership stake in his restaurant. If the restaurant fails, I'm a creditor, not an owner. The contract is still a loan.
That is a brilliant way to frame it. You have perfectly captured the essence of paragraph 15 of Ind AS 32. The accounting standard demands that classification must be based on the substance of the contractual arrangement. It explicitly ignores the substance of the relationship between the parties for the purpose of classification.
So just because there is a parent-subsidiary relationship, it doesn't alter the ink on the contract of the preference share.
Exactly. For a component to be classified as genuine equity, it must possess equity-like characteristics. And the most defining characteristic of equity is discretion over cash flows. If you own a common share of a company, the company only pays you a dividend if their board of directors voluntarily decides to declare one. It's entirely at their discretion. They can choose to pay nothing forever, and you can't sue them for it.
But with a loan, or with these 6% cumulative redeemable preference shares, there is no discretion.
None whatsoever. When a subsidiary issues redeemable preference shares with a stated cumulative rate, they have no discretion over those cash flows. They are contractually legally obligated to pay that 6% even if it accumulates, and they are contractually obligated to eventually redeem the principal. Furthermore, the standard dictates that a transaction can only be recognized directly in equity if it is a transaction with owners acting in their capacity as owners.
And providing funds that demand mandatory redemption is acting in the capacity of a lender, not an owner?
Precisely. If the parent company was truly acting purely in its capacity as an owner, it wouldn't have demanded a redemption clause. It would have just injected the capital and taken more standard common equity shares. The author of the newsletter makes a crucial point, too. Even the original EAC opinion regarding concessional loans included a specific disclaimer.
Oh, really?
Yeah, the EAC stated that advocating for this accounting treatment, recognizing an equity component for the day one difference, does not automatically mean the instrument legally becomes a compound financial instrument under the definitions of Ind AS 32.
So it sounds like the EAC offered a pragmatic, specific workaround for one very narrow scenario, and companies have just stretched that opinion to create a blanket excuse to split assets whenever they want to avoid a day one P&L hit.
That is exactly the author's contention. But what makes this deep dive so fascinating is that the author essentially says, look, we can debate the philosophy of the initial split all day. Let's put the argument about the EAC opinion aside for a moment. Let's assume you were allowed to split the asset. The real, undeniable observation here is about how they measured those split pieces and how they disclosed them afterward.
Because even if you successfully divide the asset into an equity bucket and a debt bucket, you still have to put a value on them every single reporting period. You have to measure them.
Exactly. Which brings us to the measurement maze. This is where the intersection of Ind AS 27 and Ind AS 109 creates a trap for the unwary. Let's trace the standard setting logic path. We start at paragraph 2.1a of Ind AS 109. This standard defines the scope of the rules for financial instruments. And right at the beginning, it generally exempts interests in subsidiaries that are accounted for under Ind AS 27.
So Ind AS 109 essentially acts as a traffic cop. It sees a transaction involving a subsidiary and says, hold on, you need to go down the street to Ind AS 27, which handles separate financial statements.
That's right. So the company drives down the street to Ind AS 27, and when they arrive at paragraph 10 of Ind AS 27, they are presented with a choice for how to account for their investments in subsidiaries. They can choose to measure the investment at cost, or they can choose to measure it in accordance with Ind AS 109.
So it's a fork in the road. Path A is cost. Path B is Ind AS 109. Walk me through what those two paths actually mean practically. If I choose cost, what am I doing?
If you choose cost, it is incredibly straightforward. You record the investment at the actual transaction price you paid on day one. If you paid 1,000 crore, you put 1,000 crore on the balance sheet. And generally, that number just sits there unchanged year after year, unless the subsidiary suffers a massive permanent impairment in value. It is simple, stable, and requires very little ongoing mathematical gymnastics.
Okay, and what if I choose path B? What if I opt for Ind AS 109?
If you choose path B, you are opting into the full, rigorous, highly complex framework of financial instrument accounting. You have to calculate day one fair values, you have to determine proper classification categories like amortized cost or fair value through profit or loss, and you have to constantly remeasure and track the asset based on specific mathematical models over time.
Right. And in the financial statements we are analyzing today, the company explicitly disclosed that they were measuring these separated components, both the equity component and the debt component, at amortized cost. So by writing those two words on their financials, the company essentially announced to their auditor, their investors, and the regulatory bodies, we are taking path B. We have chosen Ind AS 109.
That is the inescapable legal and accounting conclusion. Because they did not disclose that they were measuring the investment at cost, they have explicitly not availed themselves of the exemption provided back in paragraph 2.1a. They volunteered to enter the complex machinery of Ind AS 109, and therefore they are fully 100% bound by all the rules, tests, and definitions contained within that standard for this specific investment.
They opted into the obstacle course.
They did, and that decision sets the stage for a critical, spectacular, and mathematically provable failure in their application of the standard.
This is where we hit the core of the issue, the amortized cost contradiction. I really want to spend significant time here because this is where the logic completely collapses on itself.
To understand the collapse, we have to deeply understand the mechanism of the measurement they chose. We have to look at Appendix A of Ind AS 109, which provides the strict legal definition of amortized cost for a financial asset.
Define it for me. How does amortized cost actually work?
The standard defines amortized cost as the initial measurement amount minus any principal repayments, plus or minus the cumulative amortization using the effective interest method, and finally adjusted for any loss allowance.
Yeah, the phrase that jumps out there is the effective interest method. What is that mechanically? I want to visualize the spreadsheet.
Let's build the spreadsheet. The effective interest method is a way of calculating the interest income of a financial asset and allocating that income over the relevant period. It uses an effective interest rate, which is the exact rate that exactly discounts the estimated future cash payments or receipts through the expected life of the financial asset back to the initial carrying amount.
Okay, that is a very dense definition. Let me try to translate that.
Please do.
Imagine I have a spreadsheet. Column A is the start of year one. I have my initial carrying amount. Let's say it's that 800 crore fair value we talked about earlier. Column B is the interest income for the year. To get column B, I multiply my 800 crore by the effective market interest rate of 10%. So I get 80 crore of interest income. That 80 crore gets added to my balance.
Correct.
Then column C is the actual cash I received from the subsidiary. Since they're only paying a 6% stated rate on the Hollander face value, they hand me 60 crore in cash.
Right. And you subtract that cash received from your balance.
So mechanically, start with 800, add 80 for interest income, subtract 60 for cash received. My new carrying amount at the end of year one is 820 crore. The number moved, it amortized, it grew from 800 to 820.
That is exactly how the effective interest method works. The carrying amount, the actual number printed on the balance sheet, is supposed to move every single period. It changes as interest accrues based on the market rate, and it changes as actual cash is paid based on the contractual rate. The fundamental nature of amortized costs is dynamic movement over time toward the final redemption value.
But when we look at the smoking gun in these published financials, we look at the numbers for the equity component. The company disclosed the exact same amount, 855.61 crore rupees for the financial year ending 31st March 2019 and the financial year ending 31st March 2020.
Right. It didn't move by a single rupee. It's totally stagnant.
Which goes back to the car odometer analogy we started with. If you are explicitly stating in your accounting policies that you are using an effective interest method as required by the definition of amortized cost, the numbers on the page should inherently be moving. You are claiming the car is driving down the highway at 60 miles an hour, but the odometer hasn't changed in an entire year. Either the odometer is completely broken or you're actually parked in the driveway. You cannot logically claim both states simultaneously.
The identical year-over-year number proves, mathematically and undeniably, that they are non-compliant with their own stated measurement policy. Let's break down the only two possible hypotheses for why that 855.61 core number wouldn't move, and why both hypotheses lead to a violation.
Okay, give me hypothesis 1. Let's try to defend the stagnant number.
Hypothesis 1. They simply didn't accrue any interest on that 855.61 core balance during the year. They just let it sit there.
But if they didn't accrue interest, they're violating the fundamental definition of the effective interest method.
Exactly. If you don't accrue interest, you aren't actually measuring it at amortized cost, despite what your disclosure explicitly claims. You are just holding it at a frozen historical value, which violates Path B of Ind AS 109 that they opted into.
Okay, so what is hypothesis 2? Maybe they did the math differently?
Hypothesis 2. They did the math. They accrued the interest income using the effective interest rate. But they received the exact precise amount of that accrued interest in cash from the subsidiary during that specific year. If your interest accrual matches your cash received perfectly down to the rupee, the balance stays flat. Start with 855. Add 50 in interest. Subtract 50 in cash. Ending balance 855.
Right, but does that scenario hold up to scrutiny in this specific context?
The author of the Task newsletter points out why this cannot possibly be true. Think back to day one. Why did the company create this convoluted split into equity and debt components in the first place?
Because there was a difference between the fair value and the transaction price. The cash flows didn't match the market rate.
Precisely. If the actual cash flow they received from the 6% dividend exactly equaled the market rate interest income they needed to accrue, then there wouldn't have been a day one difference to begin with. The fair value would have equaled the transaction price. The entire reason they created the equity component was to park the value of the missing subsidized cash flows.
Oh, wow. That is a brutal logical trap. They trap themselves in a paradox. The very reason the equity component exists, the lack of market rate cash flows, proves that the math for holding it flat cannot possibly work under an amortized cost model. The premise disproves the execution.
It is a self-defeating accounting treatment. But incredibly, it gets even worse.
How so?
Let's look at the ultimate foundational contradiction. Let's look at paragraph 4.1.2 of Ind AS 109. This paragraph outlines the strict criteria, the absolute gatekeeper, for when any financial asset can be measured at amortized cost. It introduces a vital non-negotiable test.
You were talking about the SPPI test.
Yes, the SPPI test. It is one of the most important concepts in modern financial instrument accounting. A financial asset can only be measured at amortized cost if the contractual terms of the asset give rise on specified dates to cash flows that are solely payments of principal and interest on the principal amount outstanding.
Solely payments of principal and interest, SPPI. Let's break down why standard setters created this test. What do they care if it's solely principal and interest?
Well, standard setters created the SPPI test because amortized cost is a very simple, predictable measurement model. It only works mathematically if the underlying asset is a basic lending arrangement. You lend money, you charge interest for the time value of money and credit risk, and you get your money back. If an instrument has wild variable returns linked to commodity prices or discretionary dividends or equity-like upside, the simple math of amortized cost cannot accurately reflect its value over time. You would need fair value accounting for that. So the SPPI test ensures only basic, predictable debt instruments get to use amortized cost.
Okay, so apply the SPPI test to the company's disclosure. They have a bucket labeled equity component.
Think about the inherent definition of an equity component. By its very nature, the contractual terms of an equity component inherently do not give rise to cash flows that are solely payments of principal and interest. Equity represents a residual interest in the assets of an entity after deducting all its liabilities. Its returns are meant to be discretionary dividends or capital appreciation.
So you are saying that the very second they labeled that piece of the asset an equity component, they instantly, legally disqualified it from ever being measured at amortized cost.
Absolutely. The two concepts are mutually exclusive. An equity component absolutely cannot be measured at amortized cost under paragraph 4.1.2 because it will always fail the SPPI test. The company's disclosure is an oxymoron. It's a paradox. It is like putting an item on a menu and calling it a vegan steak. The adjective fundamentally contradicts the noun. By stating equity component measured at amortized cost, the company has explicitly documented that they are doing something the standard explicitly defines as impossible.
This is wild. It's like pulling a single loose thread on a sweater. You pull one little assumption on day one, splitting an asset based on a questionable reading of a specific advisory committee opinion, and suddenly your balance sheet is mathematically disproving itself a year later, and you are failing the most basic classification tests in the standard.
And this is where human behavior enters the realm of accounting. Because when the math starts falling apart and the paradoxes become too difficult to explain, companies often simply stop providing details that would expose the failure. The lack of movement in the numbers is a red flag, but what's missing from the report is just as condemning, which leads us to the missing disclosures.
Right, let's investigate the missing puzzle pieces. We are moving into the requirements of Ind AS 107.
Right. We need to remember the genesis of this entire situation. The company had a difference between the fair value of the share and the transaction price they paid at initial recognition. That day one difference is the pebble that started the avalanche. And because they had that day one difference, a very specific rule, paragraph 28 of Ind AS 107, which covers financial instruments, disclosures automatically kicks into effect.
And what exactly does paragraph 28 demand of a company?
It demands absolute transparency, specifically regarding how a company calculates fair value when the market isn't doing the work for them. When you have a day one difference, and that difference is not based on observable level one market data, the standard requires an extensive paper trail.
Okay, let's define level one market data for the listener so we understand the contrast.
Ind AS uses a fair value hierarchy. Level 1 is the most reliable. It means there is a quoted price in an active, open market for the exact same asset. If you buy a share of Reliance Industries, you can look at the stock exchange ticker and know the exact fair value. There is no guessing.
Makes sense.
Level 2 uses observable inputs like comparable interest rate curves. And Level 3 is the least reliable. It uses unobservable inputs. This means management is using internal models, estimated cash flows, and internally assumed discount rates to guess the fair value.
And when management is building internal models with unobservable inputs, standard setters get very nervous.
Exactly. Standard setters know that when you are using internal level 3 models, there's a tremendous amount of room for creative mathematics. You can tweak a discount rate by 0.5% and completely alter the day one fair value to suit your desired narrative. Because it is highly subjective, paragraph 28 of Ind AS 107 requires the entity to publicly disclose several detailed metrics to keep them honest.
What are the specific disclosures required by the rule? Let's list them.
First, they must disclose their specific accounting policy for recognizing that day one difference in the profit or loss statement over time. Second, they must state the aggregate difference that is yet to be recognized, meaning the remaining balance. Third, they must provide a full, detailed reconciliation of all the changes in that balance over the year, what was added, what was amortized. And finally, they must provide a narrative explanation of why the entity concluded that the actual transaction price they paid wasn't the best evidence of fair value.
That is a significant amount of explaining to do. They essentially have to prove their math to the public.
They do. And according to the author's meticulous observation of these published financial statements, the company completely failed to disclose these required details. The information is entirely absent. It is not in the specific note on investments, and it's not in the broader note detailing the categories of financial instruments. It's just, well, missing.
It feels like a situation where the initial error compounds. You make a highly complex, arguably flawed adjustment to create an equity component. You realize the amortized cost math doesn't work, so you freeze the number. But then you don't leave the required Ind AS 107 breadcrumb trail for the auditor or the investor to follow to see how you bake the cake in the first place. You're just dropping an 855 crore rupee number on the page and asking the market to operate on blind trust.
And international accounting standards do not operate on blind trust. If we connect this to the broader philosophy of financial reporting, Ind AS 107 demands these disclosures because the primary users of financial statements, the investors, the creditors, they need to understand the assumptions management is making. By omitting this reconciliation and policy data, the company leaves users completely in the dark about how that 855.61 crore figure behaves over time. When does it hit the P&L? What discount rate was used? Without the paragraph 28 disclosures, the number is basically an impenetrable black box.
But let me play the role of the defensive CFO for a moment. Financial statements for listed companies are massive documents. They can be hundreds of pages long. Is it possible they just put the paragraph 28 disclosure somewhere else? Maybe they forgot to put it in note 37 where the investment is listed, but they tucked it away in note 52 under some obscure heading. Does that save them from non-compliance?
That is a very generous assumption, and the author of the task newsletter actually entertains that possibility. But even if they did tuck that vital reconciliation away somewhere deep in the back pages of the report, it triggers a whole new set of fundamental violations regarding how financial statements are legally required to be constructed and presented.
So this brings us to the concept of obscuring the truth. We are moving out of the specific financial instrument standards and into Ind AS 1 and Schedule 3 of the Companies Act.
Exactly. We have to look at the architectural rules of financial reporting. Let's look at paragraph 113 of Ind AS 1, Presentation of Financial Statements. This standard requires entities to present their notes in a systematic, organized manner. And critically, it mandates that an entity shall cross-reference each item in the balance sheet to any related relevant information in the notes.
So you cannot just take all your disclosure papers, throw them in the air, bind them in random order, and tell the auditor, hey, it's all in there somewhere, you sort it out.
You cannot. And it is not just an accounting standard rule, it is a statutory requirement. Clause 4 of the General Instructions for Division 2 of Schedule 3 to the Companies Act, 2013 has the exact same mandate. It legally requires precise cross-referencing to prevent critical material information from being lost in a sea of data.
It is like hiding a needle in a haystack. And then when the auditor complains they can't find it, you defend yourself by saying, well, what is the problem? The needle is technically inside the barn. If you do not provide the map, if you do not provide the explicit cross-reference connecting the 855 crore figure to the reconciliation table, you are effectively functionally hiding the information from the reader.
That is exactly the terminology the standard uses to describe this behavior. Paragraph 7 of Ind AS 1 defines the concept of obscuring information. It states that information is obscured if it's communicated in a way that would have a similar effect on the primary users of the financial statements as simply omitting it or misstating it altogether. And one of the specific, explicit examples the standard gives of obscuring information is when material information is scattered throughout the financial statements.
Scattered, meaning present but disconnected without cross-references.
Right. So, to conclude the analytical journey of this specific deep dive, even if we grant the incredibly generous assumption that the company somehow put those mandatory paragraph 28 disclosures in some obscure, unrelated note 50 pages away from the core investment schedule, the sheer lack of cross-referencing from Note 37 violates the systemic requirements of Ind AS 1, and it violates the statutory instructions of Schedule 3 of the Companies Act. This scattered approach meets the exact legal definition of obscuring material information. What is absolutely vital for listeners to understand here is that in the complex world of financial reporting, clarity, structure, and navigation are just as legally binding as the mathematical accuracy of the numbers themselves. A mathematically correct number hidden in the wrong place without a map is, legally speaking, an obscured number.
Wow. Okay, we have covered an immense amount of ground today. Let's take a breath and try to summarize this incredible domino effect we've just witnessed. Because the cascade of errors is really a masterclass in why standard application must be holistic. It started with an improper, arguably illogical decision to divide a single financial asset, preference shares, into separate debt and equity components, seemingly based on a misapplied advisory committee opinion.
Yes, that was the trigger.
That initial separation led to a disclosure claiming an impossible measurement, specifically attempting to measure an equity component at amortized cost, which fundamentally violates the SPPI test in NAS 109. That impossible measurement was then exposed by flawed mathematics, specifically stagnant year-over-year balances that completely ignored the mechanics of the effective interest rate method. The resulting paradox likely necessitated missing Ind AS 107 disclosures regarding day one fair value differences and unobservable inputs. And finally, the lack of a proper breadcrumb trail for those missing disclosures resulted in the company obscuring information, violating the foundational presentation rules of Ind AS 1 and Schedule 3.
It is a textbook, sequential example of how a single misinterpretation at the recognition phase unravels the entire fabric of the disclosure downstream. When the foundation is flawed, every subsequent measurement and disclosure built upon it becomes inherently unstable.
It really is. And walking through this logical cascade leaves me with a new, somewhat provocative thought for everyone listening today. We often assume that these massive errors will be caught by the next generation of auditing technology. Everyone is talking about AI. But it makes you wonder, as AI becomes more prevalent in the auditing profession, will these nested mathematical paradoxes be flagged instantly by algorithms analyzing the SPPI test parameters? Or, because these missing cross-references and obscure disclosures are sadly so common in human-prepared financial statements, will the AI just learn to ignore the contradictions as standard industry practice? If the training data is full of these structural flaws, technology might just institutionalize the blind spots rather than fix them. It really emphasizes the need for human experts who truly understand the substance of the contract.
That is a profound point. An algorithm is only as good as its training, and if it is trained on obscured data, it will accept obscured data as normal. Human critical thinking regarding the underlying economics of a transaction remains irreplaceable.
Which brings us to some incredibly important actionable resources for our listeners today. If you are an auditor, a CFO, or anyone responsible for signing off on the accuracy of these complex documents, we urgently remind you to get your financial statements independently reviewed. Get them reviewed by GAAP advisors before you sign them. Do not wait for a suo motu review to find a cascading error hidden in your notes. You can submit your financial statements in a near-to-publishing PDF format directly via email to info@gapadvisors.com. Again, the email is info@gapadvisors.com.
And I want to highlight another massive, incredibly practical resource that GAAP Advisors provides to the professional community. If you go to their issue repository at gapadvisors.com, you will find an absolute treasure trove of knowledge. The repository currently hosts over 4,500 distinct issues and detailed expert responses regarding the application of Ind AS and Indian GAAP.
Over 4,500 issues. That is an unbelievable amount of real-world data.
It is an immense database of practical application. And what is most impressive is that any person can register for free on the site and submit their own specific issues regarding Ind AS or Indian GAAP. When you submit an issue, you will get a detailed, thoroughly researched response delivered directly to the inbox of the email you registered with at gapadvisors.com. I cannot stress enough how extremely helpful this is, particularly for an auditor. When you're sitting at your desk trying to figure out how to officially document exactly how you addressed a highly nuanced issue on the application of Ind AS, having access to that repository and that direct advisory capability is invaluable.
Yeah.
It takes the guesswork out of the documentation.
Absolutely invaluable. And finally, we want to strongly request that you, our listener, help us spread this critical knowledge across the industry. Please share this podcast among your contacts, send it to your colleagues, share it in your group chats with your audit and finance teams, and especially pass it along to students who are currently pursuing the CA course. Real-world case studies like the one we deconstructed today are exactly how we move beyond textbook memorization, elevate the overall standard of financial reporting, and spread the true, practical knowledge of Indian accounting standards.
It is all about moving from memorizing the rules to understanding the fundamental why and how behind the accounting mechanics. That is how we build better financial ecosystems.
Exactly. Well, we want to sincerely thank you, the audience, for lending us your valuable time today. We know how demanding your schedules are, and we appreciate you spending an hour with us in the accounting weeds. We request you to follow or subscribe to the GAAP Advisors Ind AS Clinic podcasts on Spotify, Amazon Music, or YouTube, whichever platform you prefer to listen to the GAAP Advisors Ind AS Clinic podcasts on. Keep questioning the substance of the contracts, keep digging deep into those disclosures, and we will see you on the next deep dive.